Hey guys, welcome back. So today I want to talk about 4 ways that a beginning investor can outperform the S&P 500. Okay? Now let's jump right in. The first way is to buy Berkshire Hathaway stock, particularly when it's selling for cheaper than what the value is. It's around, I believe, 180 now for Berkshire B shares. It got as low, I believe, as 160 in the last couple weeks. I really like it at 160. I think it's still a good buy at 180. But if you choose to go this route, buying Berkshire, really try to come up with your own value of what you think Berkshire Hathaway is worth based on the public holdings and the private company holdings. And there's a lot of information out there about this. But I think Berkshire has a strong chance of outperforming the S&P 500 index, especially now when they have so much cash. As we're heading into a recession, that's a fantastic position to be in, to have all kinds of cash to buy companies as they go on sale during this recession. So that's the first one, Berkshire Hathaway. Number 2, there's a book called The Little Book That Beats the Market by Joel Greenblatt. And in there, he kind of has an approach that he's put together for how people can invest and outperform the market by quite a bit. He's got a little table here. It's hard to see, but basically over the 20-some years from 1988 to 2009, if you had followed Greenblatt's approach as detailed in this book, your average annual return is about 24%, okay? Whereas the S&P 500, the average was around 10% for those 20 years. So it's a pretty impressive outperformance. I don't see this changing anytime soon. So, and it's very mechanical. He's got a screener that he's put together that's it's a combination of 2 factors: earnings yield and return on invested capital, which is supposed to indicate how cheap a company is and how good a company is. So the screener combines those metrics to find the best combination of good and cheap. And then every year, you'd buy the stocks that are the top performers for that time, and you would sell the ones that are no longer top performers. But anyway, it details kind of step by step how to follow that approach in the little book that beats the market. So if you're interested, check that out. Number 3, the free lunch portfolio strategy. Now, this is an approach that's detailed in the blog of Mohnish Pabrai. The website is chaywithpabrai.com. And it came out of a conversation that Pabrai had with Charlie Munger a while back, where Pabrai was kind of asking Munger, if I had to come up with a mechanical, turn your brain off approach to investing, what are some of the attributes you'd be looking for in companies, or how would you go about setting up sort of a mechanical way of picking stocks to invest in? And Munger replied, well, I'd look at cannibals, companies that are buying back a lot of their own stock. So that's the first category. Second category is cloners. So I would look at what the top investors are doing, what they're buying in the last quarter, and just add those to the portfolio. Of course, these investors have to be ones that have a concentrated portfolio approach and a long track record of success. And then the last one is spinoffs. And actually, going back to the second point, Joel Greenblatt, who managed, I believe it's called Gotham Capital in the 80s and 90s, his approach was really focused on spin-offs. And the idea is that when you have a big company that spins off a smaller aspect of that company that wasn't allowing the big company to kind of realize all of the value for whatever reason. The institutional investors that own that big company, they don't want to own the smaller spinoff. So they end up selling that right away because it's not in line with the kinds of companies that they invest in. And because there's, now all of these companies that are mandated to sell these spinoffs, you have a situation where there's a potentially depressed price for the spinoffs because it's not really a free market in that situation. There's forced selling that's taking place. So a big focus of Greenblatt's fund was these spin-off situations. And he actually had to close his fund because they were generating like 40% annualized returns. And the amount of capital got so big over the course of 20 years he ran the fund. They had to return money to investors because it's a lot harder to make high returns on a big pool of capital than it is on a small pool of capital. You have, especially when you're doing spin-offs, because those companies tend to be fairly small. And so if you're running a lot of money, you have to buy a lot of spin-offs in order to deploy all of your capital. So anyway, that's number 3, the free lunch portfolio strategy on the blog of Mohnish Pabrai. Number 4 is identifying a great investor to clone. There was a research paper wrote about how someone would have done cloning Warren Buffett. Whenever it was publicly disclosed that he had bought something or sold something, if you had just done the same, if you had bought that he had recently bought and then sold it when it was publicly known that he sold it. If you had done that between, I believe it was 1976 and 2006, by tracking Warren Buffett, I think it was like doubling the S&P 500. And while it's not super compelling anymore to clone Buffett because he has so much capital to deploy and he's not looking at some of these smaller companies, there's a very narrow kind of universe of stocks, public companies that Buffett is interested in at this point. There are other investors who are disciples of Buffett. They have a similar investment process, but they're managing a lot less money. So they can, look at a much greater universe of companies and find better opportunities because they have so many more companies to choose from, essentially. So someone I'm actually cloning now is Mohnish Pabrai. And you can do that by looking at his 13 Fs every quarter, seeing what he's buying and selling. In the last year, he's bought Graphtec, he's bought Micron, he's still holding Fiat Chrysler from, I believe, 2012 is when he bought that. Has not done well in the last couple of years, but he's still holding. I guess he sees some more runway for Fiat Chrysler. And then he's also buying internationally, which I can't see because there's no mandate that he has to disclose those holdings. I know he's got a few investments in India. I heard he was looking in the Middle East as well, like, where was it? Turkey, I believe. But anyway, that's the 4th one, cloning a great investor. You want to make sure they have a concentrated portfolio. They're making big bets and not too many bets. Like if you look on Dataroma at all of the super investors, a lot of them you'll notice like their biggest holding is like 3% of the portfolio and it just goes down from there. So that's not super compelling in terms of the cloning strategy. Pabrai likes to put 10% bets on individual businesses. And so that's a great situation for a cloning approach. And there are a number of investors on Dataroma who have that kind of a concentrated portfolio approach. And the real key here, guys, with all 4 of these strategies is to remove as much decision-making room in your own process as possible. When there are decisions to be made, that's when emotional biases can come in and really destroy your returns, okay? So make it as mechanical as possible. Set the rules up front for how you're going to buy and sell, you know, and what you're going to buy and sell. Because when you're in this game long enough, it becomes clear how many emotional biases we have that impact our decisions. The greed making us buy at the wrong time, the fear causing us to sell at the wrong time. Like, it is not natural for human beings to be good investors. There are a lot of things working against us. And so the more mechanical, the more rules we can put in place for how we're going to make decisions as we go along in our, managing our investment portfolios, the better off we're going to be. So that's, if you take away one thing from this video, realize that, you really want to set your investment process as much in stone as you can based on what works. However you come to those conclusions, and stick with those things. Certainly, we have to evolve as investors. But usually when we're doing things because we think we're evolving, really we're just getting pulled emotionally in some direction. And it's a good idea to really sit with that and analyze, okay, do I want to make this decision because I'm fearful of missing out, or is this actually a rational change that I want to make? So that's it, guys. 4 ways that a beginning investor can beat the S&P 500, can beat the U.S. stock market overall. Let me know what you think. Hit that subscribe button if you like videos like this. I'm going to be coming out with a lot more of them. And please hit that thumbs up, guys. That would really help me out. It would help more people see these videos that I'm putting out. All right, guys. Have a great day. Take care.